Today, the political process and society are completely manifested by the debate between left and right. The heart of the political debate today is over the role of government in society. The most important aspect of government and its role in society is the size of government spending in proportion to the size of the economy. The major issue that arises out of this question is how or whether government spending affects GDP growth. How would one address this topic? If there is any relation between government spending as a percent of the economy and economic growth, there can be only one causal mechanism that could explain the relationship. It would be that government spending redirects income away from investment, reducing the total amount of investment. All economic growth comes from investment and the creation of new production equipment, factories, plants, mills, mines, transportation vehicles, and construction equipment. These things don't fall from the sky for free. They take resources to make, which have to come from somewhere. If there is less new production equipment and facilities made, then there will be less new production, and production would be increased by less. If there is less of an increase in production, there would be less economic growth. Slower rates of economic growth would lead to huge differences in the total amount of production over time. That would be one explanation for the relationship between government spending as a proportion of the economy and economic growth available. Income could be redirected to the government instead of going into private savings and investment. While a lot of government spending is investment, the majority of government spending is not investment, but other uses. However, savings available and the demand for investment are two different things. Total savings available and total demand for investment could be different. A relationship between government spending and investment would cease to hold if demand for investment is lower than total savings. If total demand for investment declines below the supply of savings available, then the link between savings and economic growth breaks down because there is no demand for additional investment to be funded, and any additional savings beyond the amount demanded for investment would just go unused and uninvested. So the excess savings would be unneeded and useless and have no effect on the total level of investment or economic growth. Recently, there has been discussion of a global savings glut or shortfall of investment intentions. This would mean the demand for investment is below the supply of savings and that there has been a decline of the demand for investment relative to savings. Why would investment have declined? I'll describe several of the reasons that may have caused investment to decline. The first reason is declining population growth. Declining population growth means we don't have to invest as much because we don't have to increase production to provide for more people. More people require more production, and that means more investment is needed to build more production facilities. If there were higher population growth, we would have to invest at higher levels just to keep the same per capita production and standard of living. If there's low population growth, then we don't have to invest for that same reason, and there'd be much less need for investment. Another contributing reason could be the declining cost of capital. Dramatic increases in productivity over the last 40 years have led to significant drops in the price of all manufactured goods, including capital equipment. So the cost of capital investment has declined. Another contributing factor could be the shift of the economy away from capital-intensive sectors and the dematerialization of growth. With the shift of new economic growth to services like healthcare, the new sectors of the economy just don't require as much physical capital to start up. So there is overall decline in demand for investment. Another cause could be possible declining rates of innovation. Some have argued that we are seeing a decline in technological innovation in recent times, and if that's true, less innovation means less demand for investment, since there's less new technology to invest in. So how do investment demand and savings actually compare? On this graph, the red line is savings, and the blue line is investment as a percentage of GDP. Notice that the red line is consistently higher than the blue line. At first, it seems like total savings is consistently higher than demand for investment. But notice the green line on the graph. The green line is the federal budget deficit every year. Notice how the green and blue lines, total investment and government budget balance, seem to move together in parallel with each other. The federal budget deficit is funded out of private savings through the purchase of bonds. Budget deficits displace the use of savings for other purposes, like investment, through the phenomena of crowd-out. Even if those funds originate through private income and are counted as private savings, they are repurposed as government spending. So if the government runs deficits, the same amount of private savings is removed for government spending and no longer available for investment. Therefore, to find the actual relationship between investment demand and total savings, you have to subtract government deficit from total savings to find the total amount of private savings that are not redirected toward government spending and available. Subtracting the deficit from total savings gives us this graph. Notice the investment and savings lines almost perfectly match. The fact that total investment moves with the total supply of savings available seems to indicate that the demand for investment exceeds the supply of savings, and that total investment is being limited by the available supply of savings. Total investment seems to change in response to the availability of savings to fund it. I've analyzed this question through an analysis of total gross investment and savings. However, another way to analyze the relation between demand and supply of capital is to measure the price of capital, which is the interest rate. Another way to possibly compare the demand for investment relative to supply of capital would be to measure the scarcity value or price of savings. As I talked about in previous videos, the scarcity value is the component of profits and interest rates that is caused only by the scarcity of savings relative to demand and the price being bidded up solely because of it. Because profits and interest rates have a time and risk premium component, a good way to find the scarcity value would be to find the rate of return on an investment that has no time weighting or investment risk. The yield on a one-year treasury is just such an investment. The short time means there's almost no weighting, and as a government treasury, there's no risk of loss of value or default. So the only component of profit giving a one-year treasury its premium would be the scarcity value of capital. Therefore, by measuring the return on a one-year treasury, we can get a rough estimate of the scarcity value of capital. And the degree of that rate will tell us whether there is an excess supply of savings relative to the demand for capital. The nominal yield on an asset does not give you the full story on its value. To measure the real value of an asset, you have to take into account inflation and find how much an asset returns after adjusting for the effects of inflation. Right now, as of the time of making this video, the nominal yield on a one-year treasury is 2%. But right now, inflation is 1.6%. So the real interest rate on the bond after inflation would be 0.4%. However, core inflation and inflation expectations are at 2%, and those inflation measures might be the ones being used by the markets. So the real interest rate on a one-year treasury is either 0.4% or 0%. The higher rate of return would indicate there is some scarcity of savings relative to demand for capital, causing a scarcity premium to be bidded up. However, if the 2% core/inflation expectations figure is taken at value, then it would indicate a real interest rate of 0, and that would mean there is an excess supply of savings relative to capital. This is my all-encompassing analysis of the topic, based on all my knowledge of the area. I hope this gives an explanation of the issue and a better frame of reference to consider the topic. Please like this video, share it with others, comment, subscribe to my channel, and hit the notification bell. It would only take like 5 seconds to do any of those things, so please.